And welcome to Market Domination. I'm Josh Schafer in for Josh Lipton, live from our New York City headquarters. Stocks are down as U.S. tariffs kick in worldwide, and the president makes a big move targeting banks allegedly discriminating against customers that have been seen as risky. We'll be taking a deep dive into those stories and more. Right now, there's just an hour left until the closing bell, and stocks are lower. You can see Dow Jones Industrial Average off about 300 points, the NASDAQ off just about flat, and the S&P 500 down about 0.3%. Well, let's welcome in Steve Sosnick, Chief Strategist at Interactive Brokers, banker reporter David Hollerith, and our markets and data editor Jared Blickery, all joining us to break down the headlines. Jared, I want to kick it over to you first. Let's get a look at the markets.
Thank you. Well, let's take a look at the intraday on the Dow, because that is leading the way down right now. We're also seeing small caps down about 0.7%, so in line with the Dow. You can see we started the day on an up note there in the green. We sunk into the red, and we've just been bouncing around testing these lows for the last hour or two or so. NASDAQ Composite barely almost break even. You can see very similar chart, although we put the low in just after the 2 p.m. And I'm going to skip on down to the bond market so we can see what's happening there. We had a 30-year auction and didn't go quite as well as was hoped. Let's see if we can pull that up here. And we did see yields pop a little bit at 1 p.m. Eastern, so a net up of 1 basis point. We're not going to call that a big deal right now. Also taking a quick look at the dollar, that is also up just a tiny little bit. And looking at the sector action, it is mainly defensive. You're going to see utilities, that's up 1.3%. And then we have consumer staples. Those are the top two. We also have energy, real estate, and materials in the green. To the downside, it is healthcare. That's also defensive. That is leading to the downside. Financials, communication services also down materially. And if we take a look inside the NASDAQ 100, you can see a mixed board here. Apple getting some love after Tim Cook was in the White House. That's up 3%. NVIDIA maybe getting a little bit of a carve out from some of those tariffs. That's up 1/3%. I'm going to show you something interesting. If we take a look at semiconductors, a lot of green on this board. You can see AMD up 5%, Taiwan Semi up 4%. We take a look at software, it is a different picture. Oracle down 3%, Salesforce down 4%. I'm going to leave it on crypto here, guys, because I want to show you what's going on. Ethereum up 4%, Bitcoin up 1%. President Trump expected to sign an executive order. We're going to talk about this on crypto in 401k accounts, so I'm going to send it back to you on that.
Steve, I just want to get your take sort of on what you've been watching this session, of the session, and what you make of the action.
Well, Josh, I think to me the key was the fade. The pre-market rally and then the fade. The big overnight news was the 100% tariffs. And somehow the market interpreted that as good news, and it still actually is in the semiconductor stocks, as Jared just noted, because there's so many carve-outs for the big companies. As long as they promise to do stuff in the U.S., they'll get carved out from that tariffs. So it was kind of a nothing burger there, but it was emblematic of how we see pre-market traders and actually during market traders just chasing a rally. As soon as there's the embers of a rally, everybody has to dive in, and that I think faded because the enthusiasm just seemed ginned up, not true.
And David, I want to bring you in here. President Trump is issuing an order directing federal regulators to target banks that allegedly discriminate against conservatives, this concept being quite complex and subjective. So David, just what is at the core of this move and what is happening with this potential executive order?
Yeah, so Josh, it's calling for bank regulators to examine whether financial institutions committed any kind of politicized or unlawful debanking. The thing here is that debanking is a thing that has actually happened quite often, and banks have to do this, and they sort of assess whether or not to deny customer services based on the riskiness. And sort of the question that lawmakers on both sides of the aisle have sort of weighed and pointed to concerns about is whether or not there's been any unfair debanking related to the assessments, the discretion that bank regulators have in sort of deciding what is risky, and then also the financial institutions in deciding, how much risk they want to take with customers. So this is kind of unusual. Historically, we think of banks needing to get rid of customers, and if they don't, they get heavily penalized. But this is kind of the reverse. And there's been a number of complaints about this, actually thousands from consumers in recent years. So debanking is real, but the question here is whether or not it's being done from the standpoint of political or religious political or religious reasons. And so that's what we're kind of focusing on. And the president himself earlier this week has said that he was someone who had been debanked for these reasons, discriminated against, is what he had said. And so that is what this is addressing. It's also addressing the crypto industry, which has been had trouble with banking services and had claims of being debanked during the Biden era, especially.
And David, have we heard from any of the big banks regarding this and what they're saying?
So we haven't heard anything about this order, which President Trump hasn't yet signed today. But we have heard multiple times in the past banks, particularly ones that the president has called out, saying that they've never effectively done this, although debanking does happen. CEO of JP Morgan Chase, Jamie Dimon, has admitted that debanking does happen. So they're not in total agreement, but again, going back to this situation between the regulators and the banks that want to avoid getting penalized for having suspicious activity on their platform and keeping those clients on. There is room here maybe for more clarity, and you hear that from both Democrat lawmakers and Republican lawmakers.
Something we'll definitely be keeping an eye on. David and Jared, appreciate it, guys. And the long-awaited day is here. Trump's worldwide tariffs kick in today, Thursday, August 7th. The latest round of levies mark a substantial escalation in trade tensions that could constitute the biggest global change to the global economy in nearly a century in terms of tariffs. Let's bring in our next guest, Thomas Simons, Chief U.S. Economist at Jefferies. Tom, I just want to start with sort of the state of play of tariffs. So of course, we have August 7th come. There is a new swath of levies put in. Where are we at in terms of where the effective tariff rate is? And I know that's actually been moving higher again now,
Yes.
it seems. And then we can sort of get into how you see it impacting the data. But where do we sort of stand with tariffs?
So, I mean, this is a dissatisfying answer, but honestly, your guess is as good as mine, is sort of where it kind of lies now, because as we just sort of discussed with the semiconductors and everything, there are all these kinds of exemptions and carve-outs and delays and implementation windows and these sorts of things. So I have to imagine, the numbers that I look at, it looks like it's somewhere above 15%. I don't think it's in, much above 20 or even really close to that level. But, considering we were in the low single digits not that long ago, this is a huge percentage increase from where we were.
And then sort of to put that into the economic outlook, right? When you think about the numbers and the potential impact on inflation, I know we've started to see it in some areas of the inflation reports, right? But is it going to be that much worse moving forward now that the tariff rate is moving higher, or is it not quite one-to-one in that sense?
I don't think it's quite one-to-one. The last CPI report that we got, there was a lot of attribution of tariffs to certain price increases, right? See these big increases in household appliances, some really kind of esoteric little things like window coverings and whatnot. They were up 3 or 4%, something like that. But this is in the context of the president having announced 30 and 40 and 140% tariffs on various different countries for that period of time. So to me, I had a hard time reconciling this idea that tariffs are the sole thing driving up these prices, but the price increases are so small, right? Now, granted, that's a broad category of goods. It includes a lot of domestically produced things that are sort of, by definition, exempt from tariffs. But I don't think that we've quite seen it in the data just yet. I'm skeptical how much we are going to see, because this is just a new avenue, a new motivator for companies to try to not so much get around tariffs, but address costs, make sure that they can work with suppliers and importers and all their other individual bilateral trading partners to share this a little bit. And I think it does give some U.S. importers perhaps a little bit of leverage in negotiating with different foreign suppliers, right? So for instance, if we have a trade deal with Japan and the tariffs are 15% there versus some significantly higher rate in China, if you have two companies that are producing equivalent goods, it's now the U.S. has some pricing power, sort of incidentally from how they've applied the tariffs, but that sort of thing is all to be seen, and it's going to take quite a while for that to play out.
Steve, from an equity side, it seems like what Tom just laid out might be part of the reason why it feels like markets have started to sort of look through some of these tariff headlines. Is that kind of fair? Is that what's been happening?
Well, the piece I wrote today was basically saying that the taco trade, as a motivator, proved to be kind of false, because that acronym, which I was never a big fan of. Trump always chickens out. He didn't chicken out. We have the tariffs. I happened to look at the Yale Budget Lab today, and they were at 19%.
Okay.
Very much jiving with your very much jiving with your 20. But the bottom line is the market is so enamored just with its own momentum and fear of missing out that we're looking through a lot of these tariffs. And to your point about on prices, I think this is where the stock market aspect really comes in, because some of the cost is going to be borne by somebody. And so in some cases it's going to pass through to the consumers. In some cases it's going to be borne by the manufacturers. In some cases it's going to be borne by the retailer or the other middlemen. Well, that hurts the margins, certainly of the other two, even if it doesn't get reflected in inflation. Sure. So that's a very big piece of the puzzle for stocks that really has to be worked out.
And I want to hit on one other headline that caught my eye this morning, because we've been talking so much about the labor market. And Tom, you had continuing claims, so Americans that are filing for unemployment claims on a consistent basis, that hit a cycle high up to its highest since November 2021. Where are you in the labor market outlook right now? Obviously, we had large revisions last week. The hiring is a little bit slower, or significantly slower than we thought. How concerned are you, and how does that sort of fit into the Fed conversation?
Yeah, I mean, we definitely saw some pretty significant revisions. It's, as much as I often complain about revisions to economic data because it's, it sort of like invalidates a long-term view I may have had, it may have led me to think we were going to have a recession a little while ago that we didn't end up having. I'm used to it, basically, right? But clearly this is now kind of, the narrative has exploded into the public sphere a little bit more. But I do think that it is highlighting this kind of recognition that we are at an inflection point of some sort in the labor market, right? It typically tends to be the case that when the labor market breaks down, it sort of falls off a cliff and goes very, very fast. But we're not seeing that same sort of like build up in slack and businesses looking at headcount as the primary spot to, sort of recapture margin and cost savings, right? A lot of businesses went through an extremely difficult period of time 3 or 4 years ago where they let a bunch of people go because of COVID and stay-at-home orders and all that stuff, and then in very short order found that they couldn't find them again when they needed them when business picked back up pretty rapidly. I think the fundamentals of the economy are generally in pretty good shape. It's very heterogeneous, I suppose, in terms of different income cohorts doing better than others. But the labor market right now is just demonstrating where we are in our demographic evolution with the United States, and seeing that without the inflows of younger workers from immigration, right?
And Steve, I'm curious from your side of things. The other headline that was catching my eye this morning was Bloomberg reporting that Fed Governor Christopher Waller is likely a top candidate for the Fed chair. And I'm sort of thinking about this question for the rest of this year, whether we're talking about Fed rate cuts or who's going to be the next Fed chair. What sort of matters more to markets at this point? Is it determining what the long-term trajectory of the Federal Reserve might be based on who's going to be in the seat? Or are they going to cut by 50 or 25 in September? Are they going to cut in September? Is it more of a near-term or sort of a long-term outlook when you think about
stock markets have become increasingly short-term oriented,
yeah.
and particularly when it comes to Fed rate cuts, because it's basically, like somebody trying to bum a cigarette. Basically, they want that next fix, and if it's a rate cut, and the problem I think I get into here is stock market sometimes loses sight of the why behind the cut, because there's two reasons for a cut, and correct me if you disagree, Tom. But basically, one reason is the economy is pretty benign, and I think that's sort of the soft landing scenario that we're hoping for. Is the labor's holding up okay, the prices aren't really zooming ahead, so let's throw a cut in here. And I do agree with the Chairman Powell where he says that technically we're a restrictive policy, but practically speaking, there isn't any restrictive policy. Nobody's being prevented from doing anything with it. But that's what the stock market likes. The flip side is the economy's got problems and needs Fed rate cuts. And the Fed can be slow, and that might not do it. If you really have a slowing labor economy, which I agree with you, it's more stagnant than slowing. But if it really becomes a slowing labor economy, and at the same time we have this uncertainty coming from pricing, that's a tricky scenario for them, because they may do the cut to help the economy, but they don't want to go too far, and it might not be enough. So careful what you wish for sometimes.
August jobs report suddenly only less than a month away, right? We're going to start to get a little bit more answers. Steve, you're going to stay with us. Tom, appreciate you joining us today.
Of course, thank you.
We're just getting started here on Market Domination. Coming up, President Trump targets the head of chipmaker Intel, asking him to leave his job. What's driving this conflict? Eli Lilly having a tough day, its stock dropping. We'll be bringing you the reason behind that move. And is there truth to President Trump's claims that weaker than expected jobs data is rigged? We're crunching those numbers. Stay with us. Shares of Intel under pressure today after President Trump urges for CEO Lip-Bu Tan to resign, saying in a Truth Social post that, quote, the CEO is highly conflicted and that he must resign immediately as there is no other solution. Lip-Bu Tan was named Intel's CEO back in March, taking over for Pat Gelsinger. With the president targeting Intel's C-suite, it adds another hurdle for the company amid its turnaround efforts. For more on the rocky terrain for the chip company, let's bring in Bernstein Managing Director and Senior Analyst Stacey Raskin. Stacey, just your reaction this morning as you're reading this post. What was going through your head, and how'd you sort of make sense of it?
It's hard to make sense of it. This was pretty much my reaction when I saw it. I'd say like there's a lot of tech and semiconductor CEOs out there that have made, and maybe it's too bad that it has to come to this, but they've made personal relationships with Trump and maintain those. And look, Intel and Lip-Bu Tan really have not, right? We haven't seen him up on stage with them. He wasn't in Saudi Arabia a month or two back when all the AI news was going on. So he just hasn't made that connection. And now in terms of the tweet or the truth or whatever you want to call it this morning, Lip-Bu's connections to China are not new and they're not unknown. And I don't even think they're really conflicts. He's part of a big venture capital firm that he started, and they've had many investments in China for many, many years. None of this is a secret. It's well known. And I don't think it's really a conflict, but at the same time, like it's given the nature of this administration and everything else, it's not a great look, I suppose, especially when are drawing the specific attention of Trump. It's just not a great thing maybe to have his crosshairs on your back. But yeah, it was not something that I really had on my bingo card this morning, like that's for sure.
I don't think any of us did, Stacey. And I'm curious, the turnaround efforts at Intel and Lip-Bu's role in them, how integral is he to what they're trying to do? And I guess essentially him staying in that seat, right? How much does that matter to the company?
It is like very important, because you have to remember, like he started in March. He was coming in like kind of as a white knight to replace the former CEO, Pat Gelsinger, who was let go in December. Lip-Bu has a plan. It's kind of a painful plan. They're laying off, and there's some questions about the sustainability of maybe this is one of the issues. There are some questions about the sustainability of their investment path and process development path in the U.S. But like he's got a plan, he's putting it into place. And if you were to argue that he should not be there anymore, like who actually takes his place? Like it was hard enough to get him in that role. Like who do you convince to come in, given everything that's going on now with this administration, to replace him? And then like what are the other options internally? You have the CFO, Dave Zinsner, who was acting CEO for a while during that interim period. And I'd say Intel historically has not done all that well when run out of the finance arm. Do you try to bring Pat back? Would that even be an option? Would it be desirable now? Like, I don't even know. So like, if he's not there, if they decided for whatever reason that the best thing to do was to not have him, so I don't know what they do. Like it causes a lot of uncertainty. Yeah.
And Stacey, I want to broaden this out because I don't think Intel is the only chip company that might be confused by what the president's saying today. The president also saying yesterday that they'll be putting a tariff of approximately 100% on chips and semiconductors, but then saying that if you're building in the U.S. or planning to build in the U.S., then maybe you're exempt. How do you make sense of that language? What are you getting at?
Yeah, it is tough. So like, he made some comments yesterday, and that's what we have to go on. This is all part of what was called a 232 investigation into semiconductors and other things. And we actually haven't seen the report from the 232 investigation. So once we see that, I think we can start to be a little more prescriptive about what the actual impacts will be. Like right now, we're just trying to decipher his comments. And look, this is Trump. He makes comments all the time, and sometimes they lack detail and nuance, right? And so we don't actually know like what it means. What he did say, you're right. He said there's going to be 100% tariffs on semis, but if you're building here in the U.S., then you'll be exempt. And there's a bunch of stuff. But there's questions. What does building in the U.S. mean? How much do you have to build? Like, what's the time frame? Is he talking about semiconductors? Is he talking about the end devices? Will there be tariffs on just raw semiconductors coming into the U.S., which is actually not that much? We don't import that much. Or is it tariffs on semiconductors in devices? Can customers still use, TSMC manufacturing capacity in Taiwan with no tariff because TSMC is building a lot in the U.S.? Like, I don't know. I don't know exactly how to parse this yet. We will have to wait until we see the actual report. I think, though, the reason the stocks are up is it does look like there will be some loopholes or some reprieves from the blind 100% tariffs. And, there are semiconductor companies and other like tech companies that are investing a lot in the U.S. and trying to build here. And so I think there's a perception, which hopefully it's at least there's some truth to it, that there will be some reprieve from this. We won't know for sure. We won't be able to really be specific about it until we actually see what is going on when they actually file the regulations.
And so I know this then makes the final question sort of hard to answer, right? But as an investor in the space, is there a winner or loser from sort of what we just laid out, or who's kind of best positioned then given that?
I mean, like the knee-jerk reaction, you'll say, look, companies, at least on the semiconductors, the companies that are actually actively building here, presumably would be, perceived as relative winners. So, I mean, you got companies like Texas Instruments, for example, who are building a significant amount of capacity in the U.S. That is their plan, and they've been delivering on it, and there's more to come. You have companies like NVIDIA. Like NVIDIA doesn't build chips, like they're fabless, they outsource manufacturing, but they're investing a lot of money in the AI supply chain. At least they're giving headlines, so you have that. I mean, you've got fabless companies like AMD or Qualcomm or whatever that actually can use in TSMC in Arizona. And there is a read of the comments that suggests maybe they could continue to use the Taiwan stuff tariff-free. Like we don't know yet, but like maybe. You've got the semi caps. Like again, if we have to build more capacity here in the U.S. at the margin, that's probably incrementally positive for the U.S. semi cap players. So those are the kinds of like knee-jerk reactions that I mean, in some sense, are probably going on today. And again, we'll know more like when we get more specifics.
All right, Stacey, we're going to have to leave it there. We're going to have you back once we know more. How about that?
Yeah,
Thank
you bet.
for joining
You
us.
bet.
Now time for some of today's trending tickers. We're keeping our eye on Duolingo, Eli Lilly, and Airbnb. Shares of Duolingo popping on a top and bottom line beat in the second quarter. The language instruction app raising its third quarter guidance and full year guidance. The strong results powered by increased user growth thanks to artificial intelligence. Steve Sosnick from Interactive Brokers still here with me. Steve, what do you make in this move in Duolingo?
Well, like many of these moves, it got a little overcooked at the beginning of the day. I pulled up the chart, where it was up 30%. And now I've just happened to pull it up now, and it's like $60 off its highs, which is still a huge number. I mean, it's one of these. I just have to take it as one of these names that people get excited about when they do. The stock had been a great performer, then it had fallen back a bit. I do believe there's some short covering involved in today's rally because the stock had not been near its highs, and even after today's huge move near the open, it had fallen back. So I think it's a lot of technical. You put good news onto some poor technicals, and that is the type of good response that you get, although perhaps a bit over-enthusiastic.
Sure, and this might not have popped the stock 14%, Steve, but did you know that you can now learn chess on Duolingo? I got to check that out.
I do have to check that out. I have tried to learn French on it. I've gotten, mez, shall we say.
It sounds like the growing AI bot they have will help us with that, right?
Exactly.
We're also taking a look at Eli Lilly today, too. Those shares are plunging on disappointing data for its new weight loss pill. That's overshadowing strong growth from the company's current obesity medicine. The pharmaceutical company says participants lost less weight and experienced more side effects than expected for the pill that could be an alternative to the anti-obesity shot if approved by regulators. Steve, Eli Lilly down 13% today. I think combining this story with what we heard from Novo Nordisk last week is interesting, and sort of just the GLP-1 story getting a little bit deflated in 2025, it seems. It's been interesting to follow that throughout the year.
Wish I could lose weight as quickly as these companies'
Right.
stock prices. I mean, bottom line here is you noted there were sort of two big thematic trades for a while. It was the GLP-1 trade and the AI trade. Well, the AI trade is still going strong. The GLP-1 trade is kind of behind us here at this point. I mean, Novo Nordisk, hit the skids first, but now Lilly, I think the psychology was set up so that Lilly had to do something to overwhelm from the bad vibes that were coming out of Novo, and they didn't. They couldn't. And I think ultimately the feeling is we have what we have. These are potentially great products. But maybe the skyrocketing growth that's been priced in is not coming to fruition. These are still good companies.
Right. Well, that seems to be the difference, though, right? When we compare it to the AI trade, is that's still a better than expected. Expectations are doing better. AI is driving more profits for a company like Meta than people thought, right? Versus GLP-1s. Investors maybe in the street maybe just got a little bit ahead of itself with how quickly they can actually scale this business.
I think that's really what it comes down to. Because remember here, the difference is ultimately, at least in the US, when it comes down to anybody using medications, the insurance companies really are the final gatekeepers. And these are expensive products, and it's tough to imagine that these companies just want it. There's a pro and a con. There's cost to obesity, but there's cost to the medication. I don't know the whole cost-benefit analysis that they're doing, but as far as whereas AI, it's basically the market. The more money that these companies throw at AI, the more the market rewards them. So why not keep doing that?
Right, and there's less guardrails for now in that industry, right?
Absolutely.
Than there is in healthcare. All right, Steve, we got one more stock we're taking a look at here. That is Airbnb. Shares sliding after announcing the company's $200 million investment in a new services and experience program and redesigned app that's going to affect Airbnb's margins. The popular home rental app beating on earnings expectations, though, for the latest quarter, but that outlook causing the stock to fall. Shares are off about 9%. Taking a look at Airbnb, really since the IPO, the stock hasn't really gone anywhere, which was kind of surprising to me. Even you look over the last year, the company coming out and saying they feel good about travel demand, but it seems like something in the fundamental story for Airbnb, even though we all use it at times, doesn't quite seem to be working right now.
It's another one of these good business, but how much can you grow that business? First of all, you're reliant on people renting out their homes.
Right.
And you had that rush of people who'd basically been buying places in order to rent out on Airbnb. That might have gotten a bit saturated.
Sure.
The other thing is, I do think there are cutbacks in travel. I mean, look at what we hear about, Las Vegas tourism and things of that nature. So if Airbnb is exposed to it, and so they're going to spend money, but to redo this stuff, like any business, you have to keep spending money just to stay in place at some level. But ultimately, they can't be immune from the type of macro environment that's hurting a lot of the other travel companies.
Definitely, and obviously that spending, what it actually does to the travel experience potential revenue segment for them is going to sort of be that key question moving forward. Coming up, much more market domination coming at you after the break. President Trump has been a loud critic of government data, most recently shocking investors and policymakers when he fired the Bureau of Labor Statistics Commissioner. Trump making that decision following his claims that the weaker than expected July jobs report was, quote, rigged. But how exactly are these economic data points collected? Let's get over to Yahoo Finance's Jared Blickery, who has a breakdown.
Yes, Josh, the political fire is hot, but the numbers underneath it are what really matters. So let's check them out and look at these bars, which was what first was reported way back in May. And when that was released, it was 158,000 new jobs. And in June, we saw an increase of 140,000. That you can see on your screen in those big green bars. But when the July numbers dropped, and they weren't that great themselves, those two prior months shrunk dramatically to 19,000 and 14,000. That is 250,000 jobs gone, the biggest two-month downward shift outside of a recession since 1968. But remember, that first number is basically a rough draft, and history says it can miss by about 130,000 either way. So big swings, they happen. And the bottom line is, 3-month hiring is now at a modest 35,000 per month, and this is not what we consider boom times. Now let's tour the data factories. First up, we have the Bureau of Labor Statistics, It cranks out jobs, inflation, and vacancy numbers with a turnaround of about a few weeks. We're going to dive into the particulars here in a minute. Next up, we have the Census Bureau. Think retail sales, housing starts, factory orders. It has the same fast clock measured in weeks. And then we have the Bureau of Economic Analysis, or BEA. That's where you find gross domestic product, consumer spending, and a different look at inflation. Now, the star of today's show is the Employment Situation Report. It's a monthly snapshot of payrolls, wages, and joblessness. It's based on the week that includes the 12th of the month, and it usually drops the first Friday of the month. The BLS uses two different surveys to put this report together. One is called the Household Survey, which, as you might guess, surveys households across America. It comes from calls and online forums to about 60,000 families. Who's working? Who's looking? Who's sitting out? The other half comes from a survey of businesses that hire the workers. That's called the Establishment Survey. And it comes from emails and web forms sent to roughly 120,000 employers. That's where the headline payroll figure comes from. That's the source of all this recent controversy. The problem is fewer forms are coming back. Over the last decade, and this chart shows this, household responses slid from about 88% to 68%, and business responses, they tumbled from 61 to 43%. And you can see in that chart that it was really the pandemic that slowed the response rate, and things have just not bounced back. Less input on day one means a bigger cleanup crew later, and that's why revisions can look jarring, as they are right now. On top of the monthly tweaks, guess what? Every February, that brings what's called the benchmark revision. Payrolls get matched to tax records, and this year it erased nearly 600,000 jobs from 2024. But the original benchmark revision was even higher, 818,000, which was another data point that President Trump recently measured. So if you're following along here, even the revisions get revised. Now, at the last Federal Reserve press conference, Fed Chair Jerome Powell put it this way: government data is the gold standard in the US. We need it to be good and we need it to be reliable. And that gold standard now sits with a new acting commissioner at the BLS and his team of statisticians. The next jobs report drops Friday, September 5th, and we're going to be sitting here on pins and needles for the next draft of the truth. Josh, back to you.
Appreciate that outlook, Jared. Stocks giving back earlier gains as investors parse earnings and tariff uncertainties as new levies take effect. The slowdown comes on the heels of a winning session, though, where the Mag 7 index hit an all-time high, led by gains in Apple as the big tech giant announced an increased investment in the U.S. under pressure from President Trump. Apple continuing to defy today's slowdown, up about 3%. Joining me now is Rich Bernstein, CEO of Richard Bernstein Advisors. Also still have Steve Sosnick from Interactive Brokers on the desk here with me. Rich, I want to start on just the Mag 7 rally that we've seen really over the past week. Most recently, it was Apple. Of course, a lot of the other hyperscalers had pretty solid earnings last week. You've called them the mid-7 before. You're sort of waiting for this trade to maybe end, right? What do you make of the recent moves we've seen, and kind of how are you reading that part of the market?
So, Josh, two things. Number one, I think there's nothing wrong with the Magnificent Seven companies per se. You know, the question is not whether they're magnificent or not. I guess that's beauty's in the eye of the holder of the stock. But the question that I think that people should be asking is, are they unique? And are their growth patterns unique to justify the valuations that go along with these stocks? And I think the answer to that is an unconditional: they are not unique. There are many companies growing both inside the United States and outside the United States. And so therefore, the attention that they're given and the valuations they're afforded, I would argue, are clearly speculative. And there's a speculative element going on here that I think opens the door for true fundamental investors who are a little more patient to really start investing and looking for these other companies that are being ignored but growing the same, if not better.
What are the other companies then, Rich? Where do you have your eyes set on?
So for me personally, I think the cream of the crop of the companies that are growing the same or better and people are ignoring would be quality stocks outside the United States. Look, let's set the stage here for a second. I don't think most people realize that the Euro Stoxx index is up about 20-something% this year. Germany is up 30-something% in U.S. dollar terms versus NASDAQ up 9 to 10. Right? So the backdrop is you've already got a lot of performance going on that nobody cares about. But if you look at non-U.S. quality, their growth rate, their anticipated growth rate, is the same, in some cases better than the Mag 7. They give you 10 times the dividend yield, basically 0.3 versus 3, and they're selling at discounts of 30 to 50%. So, Josh, the way I like to think about it is, if you could buy a Maserati for the price of a Chevy, wouldn't you do it? I think you probably would, and I think you'd probably ask me for 2 or 3 of them. Well, that's basically what's going on as the Maseratis are on sale.
Rich, you recently contributed to our Yahoo Finance chart book, and so too did Steve Sosnick, who's sitting next to me. And you just hit on essentially exactly what Steve and I talked about during that project. Steve, you highlighted international stocks, right? Yes. And you pointed out that rally. I mean, what do you make of sort of that side of the trade? Is there still more opportunity, given the rally that we've seen outside of the U.S.? Is that an area that you'd still be looking for?
I would be, because for the reasons Rich just said. I mean, there are a lot of stocks that have been overlooked for years, and certainly you can't. One thing you can't say about the Mag 7 and friends is that they've been overlooked. Everybody who's anywhere, thanks to just their weights and indexes and FOMO and all these other factors, have been investing in them. So yes, if you can find these alternatives outside the U.S. or wherever, well, you know, even in the U.S., but generally there's more of them outside the U.S. People have gotten more attuned to that. I think, you know, as the calendar turned, but that trade is not over yet. There's still plenty of value out there. I'm certainly not going to argue with that.
And Rich, you pointed out in our notes, Justin, you just mentioned it, there's plenty of signs of speculative trading we could point to in the market right now, right? Whether it's penny stocks, it's Goldman Sachs' unprofitable tech index soaring higher seemingly every day. That doesn't just end, though, necessarily on a random Tuesday because it ends, right? There's perhaps maybe a catalyst that comes or something that would unwind that. What are you watching to bring that trade maybe back to reality a little bit?
Absolutely. Well, my new indicator for Europe is whether Steve becomes fluent in French or not, since he mentioned that he was taking French in Duolingo before. When he gets fluent, then I think the trade's probably over for Europe. I think we have a ways to go on that one. Absolutely. I'm going to guess. But but I think, look, most speculative periods end for one or two reasons or both. And reason number one is that the central bank has to tighten, because inflation's too strong. The nominal economy is too strong. Inflation plus real growth. And when the Fed raises rates, they essentially make the cost of leverage more expensive, and they begin to withdraw liquidity from the economy. And the way to think about it is that people stop. And the other side of that would be that maybe there's a recession or recession. Right? When you get that combination, people stop speculating because they have to buy bread and groceries and things like that. They're not speculating on Bitcoin. They need bread. Right? I mean, that's a very simple economic concept. You know, whether it's casinos or it's Bitcoin, the same thing tends to happen. And so I think what the markets have to look at very carefully here is the dilemma that the Fed is faced with. Right? Are the employment numbers weak enough so the Fed can cut rates, but not weak enough to cause a recession so people start shifting from Bitcoin to bread? That's the dilemma that the Fed is in right now. I mean, they're really caught.
Seems like a fine line to be walking, Rich. We're going to have to leave it there. Appreciate you joining us.
Sure. Thanks for the invitation.
President Trump expected to sign an executive order that opens the door for retirement savers to invest in alternative assets like crypto and private equity within their 401k plans. Private assets have not typically been in 401ks due to some of the risks associated with the investments, such as higher fees, lack of transparency, and long lockup periods. But backers of the plan say private assets offer diversification and the chance for high returns over time. Joining us now with more is Yahoo Finance senior columnist Kerry Hannon. Kerry, what are experts telling you about just the opportunity for one of us to be able to do this in our 401k? Are they saying Bitcoin full 100% 401k, or how are we sort of thinking about it?
Yeah, Josh, the word is caution, caution, caution. I think there is, you know, this is coming at people sort of fast. The concept, these have been in pension funds for years. It's not a whole new thing. It's just that plan administrators aren't sure how to incorporate them in the 401k plans. And so we don't actually know what this is going to look like. According to the experts I talked to, they're like, we don't know. Are they going to be part of a mutual fund that people invest in? Or are they a separate entity? So you're very clearly identified that these are, these private assets. And so it's unclear. And they all sort of said to me, there are different flavors. There's all kinds of flavors. They all are going to carry different risks with them. And so it's something that the lay investor probably is not going to understand. The big concern is if you put these out there without really some education for individual, the average investor is not going to understand what you just mentioned. The liquidity, they're harder to get out of, that they have, yes, potential to juice up returns. So there is that positive, but these tend to be come with fees that make it a difficult investment for someone, and particularly if you're short term, you're nearing retirement or something. If you have a long horizon, it could be what one expert I spoke to today said, okay, so if you think you get it, you understand it, you want a little bit, stay in the 5 to 10% range of your retirement portfolio. You don't want to go crazy on this stuff, because what happens is the fees, which we all talk about a lot, the fees cut your ultimate returns. And that's what the retirement investor is looking for, returns, so that they can accumulate money for the retirement. So fees are extraordinarily important. So we need to figure out how this is going to show up in the retirement accounts. But I'll tell you what, it is going to. So the path has started.
We're going to have to leave it there. I appreciate the insights, Carrie. Good info. Coming up, the competitive streaming wars fight for loyal viewers, but we're giving you the best plays when it comes to investing in the digital sector. Stay with us. That story and more when we return. We're seeing some big names in the streaming space reporting earnings, including Disney on Wednesday and Warner Brothers Discovery on Thursday. Both those stocks have been under pressure as the battle continues for streaming rights, particularly for the NFL. We're navigating how to play the streaming sector with the Yahoo Finance playbook. Joining me now is Jessica Reif-Ehrlich, Senior Media and Entertainment Analyst at BofA Securities. Jessica, now that we've heard from a fair amount of the streamers, I guess from a high level, zooming out, what has been one of your bigger takeaways, or maybe the biggest takeaway of what we're learning about the various companies in the space and sort of who's leading and where everyone's at in this process?
I mean, from the traditional media companies' perspective, they are all turning the corner. They're starting to see profitability. They're inflecting to profits. Disney reported great numbers and raised guidance. The same with Warner Brothers Discovery. So their businesses have turned the corner. Subs and revenue are growing. They're still rolling out, in Warner Brothers Discovery's case, in more countries, HBO Max, with more to come in the first half of 26. But unlike Netflix, which of course has been doing a phenomenal job, traditional media companies are battling the headwinds from the decline of, or the secular headwinds from pay TV. So from a streaming perspective, it's actually been very strong. But from the rest of their business, there are still some significant challenges.
In the big headline, it felt like over the last week was the Disney NFL deal, right? And as a Red Zone watcher, the fact that Red Zone will now be on ESPN, how much does that mean for Disney's actual business to be able to have Red Zone and have that sort of product?
Disney had a ton of news in the last day or so. As you mentioned, like Red Zone with NFL. So the NFL deal doesn't technically close until the end of next year, so it doesn't affect Disney's numbers until fiscal 27. Having said that, their relationship with NFL has been cemented. They will get an incremental 3 games. They'll move games around to different platforms. And so it just strengthens their hold on sports significantly. We would not be surprised to see other sports networks, platforms bundle with ESPN. ESPN is clearly the leader in that. But there was other news in Disney's streaming besides the NFL, which of course is a really big deal. On the call yesterday, Bob Iger talked about rolling Hulu into the Disney Plus app on a global basis. So they'll rebrand from the Star name, which was their Indian operation, to Hulu, and it has puts and takes. So when you see these kinds of combinations, there has to be pressure on revenue. We'll see what the bundle price ultimately is. They have not announced that, but there will be a definitive benefit from a cost perspective, from marketing and technology, should help engagement, should reduce churn. So we're trying to parse through these numbers is a little bit difficult. There were a lot of moving pieces in Disney's announcement yesterday related to streaming, including the NFL.
And Disney, of course, has a broad other business, and several of these other companies have linear cable networks that are also part of the business. The one that doesn't, as you mentioned, is Netflix, right? And that's sort of your pure play still for streaming. Is that, if you're looking to invest in the streaming space, is that still the most attractive option because of the fact that it's a pure play streaming play, or is it maybe not, given the stock has been, seems like, running wild for a while now? Not off earnings, but leading into earnings at least.
Yeah, but it's night and day valuation. So yes, it has a clearer path because it's not burdened by these legacy businesses. We'll see. There's going to be M&A in media in the coming year. Does Netflix play a part in that? If they choose to, then they may be burdened by some of these challenges as well. But they would only do it if they thought there would be a big benefit in terms of owning more IP. But on the other businesses, so yes, like Warner Brothers Discovery had a fantastic quarter led by streaming and studios. But the linear business, while it was actually fine this second quarter, there are some challenges in comparisons in the second half. So that will weigh. That is what is weighing on the shares today. Disney, on the other hand, had like phenomenal outlook on experiences, which is basically their theme parks and cruise ships. So the theme parks, despite increased competition from NBC Universal's Epic opening in May, did extremely well in Orlando. Bookings are really strong, and they have 2 new cruise ships coming on this calendar year, in November and December. So the outlook for Disney on the experience side is incredibly positive. So they're just puts and takes. So if you want a simple story, it would be Netflix, but you're paying for it at a significantly higher multiple, like 4-fold what the other companies are trading at.
Jessica, we're going to have to leave it there. Appreciate you joining us today.
Thanks.
Well, 2 major car makers are driving a big project together. GM and Hyundai are partnering to co-develop 5 new vehicles for the Americas. Let's bring in our senior autos reporter, Pras Subramanian. Pras, what's the deal here? 5 new vehicles?
Well, so we have interesting forces joining forces here. GM and Hyundai both make really great EVs already. Now, got a quick correction there. It's 5 vehicles. 4 of them are for international markets. One of them is going to be
only one of them is in the U.S.
Yeah, that's going to be a commercial van. But the other 4 are interesting because it's probably going to be cheaper, smaller EVs that do better in international markets, and they can co-develop them, make them cheaper, make them in different production facilities, share those costs. And I think that's why you want to do that. You want to have these more cost-efficient EVs in smaller markets, international markets in particular, and then sort of maybe GM and Hyundai keep building their more mainline EVs on their own that people find really helpful. GM sold, I think, the most Equinox EVs ever last month, so doing really well there. But yeah, this is a good deal for them in terms of like sharing costs and sort of making that happen across other international zones.
Something we'll definitely be keeping an eye on. Appreciate you joining us, Pras. Well, we're wrapping up today's market domination. Do not go anywhere. We've got you covered with all the action following the closing bell. Stay with us.